holding and trading cryptocurrencies like Bitcoin and Ethereum can be extremely profitable. However, you may owe significant capital gains taxes when you sell or trade your crypto for a profit. Depending on your tax bracket, federal and state capital gains taxes can claim 20 to 30% or more of your crypto earnings. Welcome back to Tax and Credit Essentials. What if I told you there's a completely legal way to make millions in crypto profits and pay zero taxes? I bet you think it sounds too good to be true. I'm going to let you in on the secret. In this guide, you'll discover the step-by-step approach to setting up a Charitable Remainder Trust, an IRS-approved tactic that allows you to avoid crypto taxes while still providing for your loved ones. First, let's look at why the normal route of selling crypto and paying capital gains taxes is so problematic. Unlike cash donations or gifts, cryptocurrencies are treated as property for tax purposes when you sell or trade them. This means they are subject to capital gains taxation. For example, let's say you bought $5,000 worth of Bitcoin years ago. Due to Bitcoin's incredible price appreciation, those coins are now worth $500,000. Congratulations. However, now you want to sell some of your Bitcoin to diversify your investments and realize some of those massive gains. The trouble is, if you sell the coins directly, you will owe a lot of taxes on the $495,000 capital gain. Specifically, you will owe federal long-term capital gains taxes of 20% and state taxes around 5%, totaling 25%. So selling your $500,000 in Bitcoin would generate a $125,000 tax bill, 25% of $500K. That's money directly out of your pocket and off the top of your profits. And you only have legitimate options to reduce taxes before you sell the crypto. Once sold, the tax man cometh. Fortunately, the Charitable Remainder Trust, CRT, provides a way to entirely avoid capital gains taxes on appreciated investments like crypto. Next, I'll explain exactly how a CRT works, then go step by step through setting one up. A Charitable Remainder Trust is an irrevocable trust designed to reduce taxes for investors with appreciated assets. It works by allowing you to donate those appreciated assets to a trust you control. Since CRTs are 501c3 charities themselves, you get an upfront tax deduction when donating to one. The CRT then sells your assets tax-free, since charitable trusts don't pay taxes. The proceeds can be reinvested however you like tax-free as well inside the CRT. You receive an annual annuity payment from the CRT for life. When you pass away, the remaining assets go to the charities you selected. However, your loved ones can still inherit tax-free through the use of a related Irrevocable Life Insurance Trust, ILIT, which I'll explain more later. Next, let me walk through exactly how to establish this process step by step using the previous Bitcoin example. Step 1, speak with a lawyer about setting up a CRT. The first step is to speak with an estate planning lawyer or wealth advisor about setting up a Charitable Remainder Trust. It will cost between $3,000 to $8,000+ to establish a CRT, depending on complexity and your attorney. Inform the attorney you wish to name yourself as the lifetime beneficiary. You will also choose a qualified public 501c3 charity to receive the remainder value upon your death. Once created, the CRT can open its own bank and investment accounts to receive the asset donations. Step 2. Donate your appreciated assets to the CRT. Next, you will formally donate your appreciated investments like the $500K Bitcoin to the CRT you created. As a charity itself, the CRT gets an immediate tax deduction on the estimated present value of the assets it will donate to public charities once you die. This deduction is based on IRS actuarial tables and discounts the value since the charity has to wait decades to receive it. For assets donated to public charities, you generally get an upfront CRT deduction of 30 to 40% of the value. So $150K in our example, 30% of $500K. Step 3, sell assets tax-free. Inside the CRT, now the CRT can sell your assets tax-free since charitable trusts don't pay taxes. In our example, selling that $500K in Bitcoin inside the CRT would not trigger any capital gains taxes. The full $500K proceeds are available for reinvesting. Step 4, reinvest and receive lifetime annuity payments. Next, the CRT reinvests the sales proceeds into a portfolio of income-generating assets, like stocks and real estate. As the trust creator, you can provide input on the specific investments. The CRT will then pay you an annual annuity, fixed payment for the rest of your life funded by the portfolio's earnings and distributions. The annual annuity payment must equal at least 5% of the initial funding value, so around $25,000 per year minimum in our example. These annuity payments are taxable income, but usually at a lower rate than capital gains depending on your bracket. You also spread the tax payments out over your life. Step 5. Use an ILT, so your heirs still inherit money. Finally, if you want your loved ones to still inherit money in a tax-advantaged way, set up an Irrevocable Life Insurance Trust ILT. You fund the ILT with a life insurance policy on yourself in the amount you wish your heirs to inherit, perhaps that same $500,000. The ILT purchases and owns the policy but names your desired beneficiaries. When you pass away, the tax-free life insurance payout goes to the ILT beneficiaries per your instructions rather than the CRT or charity. To fund the policy, gift money to the ILT each year or use your annuity payments from the CRT. Estate taxes won't apply since the ILT owns the policy proceeds, not you. First, you avoid all capital gains taxes when contributing, selling, and reinvesting your appreciated assets inside the CRT. For crypto investors, this tax-free compounding over one's lifetime is extremely powerful. Second, you get an upfront income tax deduction for the present value of the amount projected to go to charities upon your death. This percentage deduction is usually 30 to 40% of asset value. Third, you reduce income tax long-term by spreading annuity payments over your projected lifetime rather than owing all capital gains taxes immediately once you sell your assets. So you reap tax savings now, plus in the future. Fourth, you can still make sure your loved ones aren't left out through pairing the CRT with an Irrevocable Life Insurance Trust ILT funded with life insurance. While very advantageous, setting up a charitable remainder trust also has some downsides. Generally requires $100K plus dollars in capital gains to be worthwhile. Complex to establish, need an estate attorney. Inflexible once signed, hard to change terms. Lose outright control of the donated assets. Additionally, everything must be set up correctly from the start and followed precisely over decades. Operating outside the strict legal rules can negate all tax benefits down the road. The key is following the rules and not getting greedy. Patience and proper planning allow you to grow an enormous tax-free nest egg that benefits you, your family, and charities. Just remember, you must establish the CRT and transfer appreciated assets before selling them yourself. Once liquidated, the capital gains tax liability is fixed. Do you think charitable remainder trusts should be more widely used among crypto investors? Let me know in the comments section. And there you have it, the step-by-step blueprint for how to legally eliminate taxes on your Bitcoin and crypto earnings using charitable remainder trusts. If you found this guide helpful, be sure to subscribe to Tax and Credit Essentials for more money-saving tax tips and tricks used by the ultra-wealthy.